Hello and welcome back to Onchain Reaction. I'm your host James Bennett and I'm the CEO of ByteTree. We provide on-chain data for digital asset investors to navigate the crypto ecosystem. Okay, so let's jump into it by looking at the on-chain transaction value that we've seen on Bitcoin over the last few days. We've actually peaked above $5 billion settled per day as price surges through the $15,000 mark and up towards $16,000 at time of recording on the 11th of November. Now we can see that typically, this only happens during bull markets. So earlier this year in January, prior to the liquidity crunch we saw in March, transaction value there was above $5 billion, highlighted in that gold circle. And prior to that, the only time we saw it was around that late 17 bull run, and we all know what was happening at that time. So it's very exciting for Bitcoin at the moment. Not only is the price surging, but we're also seeing a pickup in on-chain activity. Okay, so now moving on to our next chart. Here we can see the difficulty rate. Last time I spoke to you a couple of weeks ago, the difficulty was at an all-time high, which means that there was the highest amount of hash power dedicated to the network in Bitcoin's history ever. And we were anticipating that because block times had been slowing down, which is indicated by this blue line here on the far right side, you can see that block times got up to about 12 minutes per block on a 14-day moving average. And that led to one of the largest difficulty adjustments in Bitcoin's history. So actually the second largest, a drop of about 18%. And we think largely this was caused by seasonal adjustments. A large proportion of the network is mined in China, and as the wet season arrives, the miners move out, they pack up their old rigs, send them abroad, and of course stop allocating that power to the network. So we can see that the block times have responded very quickly to that and are now coming down. You can see it's 14-day moving average, but over the last couple of days, we're seeing blocks coming out a lot quicker than 10 minutes, sometimes towards 8 minutes per block. Okay, so as we know by now, this impacts miner revenue. So surprisingly, miner revenue has actually remained or reached and held above $15 million per day over the last few days, which is pretty impressive considering that block times had reduced, so the number of new blocks coming through was lower, and really that was on account of the rising fees offsetting that reduction in block reward. Fees peaked at about 22% of total miner revenues and are now starting to turn back down, slightly more sort of normal level if you like, but normal within this new epoch where we have half as many bitcoins being rewarded. Of course we went from 12.5 to 6.25 bitcoins as a Coinbase reward in May, and fees have stepped up to offset that revenue. So here what I'm showing, the horizontal line is indicating where $15 million per day is, and the dark blue bars indicate the revenue for that day. And you can see that up until the last few days, revenues had generally dropped after the halving, but now are holding relatively steady, and again even above levels that we were seeing in late 18 when we were in the bear market, of course with a higher block reward but less interest in the network and less fees. So overall, mining ecosystem is looking healthy. So if we dive in now to miners' inventories, at ByteTree this is one of our favorite indicators to look at, and we can see that miners have been depleting their inventories at a very high rate, not seen since the 2017 bull market. So our working thesis, as you may well know by now, is that miners sell into a strong bid in the market. So when they think the price will hold up and they think it's a good opportunity to sell, then we tend to see them shifting large parts of their inventory, and that's exactly what's happening now. So if we look at what this means for inventories more broadly, on this last slide here, we're looking at the rate of change in inventories. So inventory this year compared to last year on a rolling sort of 12-month window, and as a percentage of the total inventory available. And you can see the sort of 0% level there. So if inventories are changing 0%, it means that all the new coins being generated are continuing to be are being sold. So for every new coin generated, it's then moved into the market. So inventories remain net zero, but that's not the trend that we typically see, because miners of course have their own behavioral preferences. And what we can see is the rate of change of that inventory level has an inflection point at the beginning of bull markets. So if you look towards 2014, 2015, you can see when the rate of change started trending down. So that means inventories are being offloaded at a faster rate than they were before. That's when we moved into that bull market of late 16 all the way through 17, and then that inflection point at the end of 17, which marked the beginning of the bear market that was coming. And then you can see again sort of in the towards the middle to end of 2018, we had that inflection point, which was the capitulation in December 19, which then saw the beginning of the next sort of short-term bull market that lasted up until the middle of 2019. And you can see there again the inflection point when we start to move back up there through the slightly weaker period from mid-19 last year until January of 2020. And of course now we're starting to see the beginning of the next bull market, which is the current one we're in. So miners are an excellent source of information on the market, and you can find out more about that at ByteTree.com. That's all for me for now. Have a great week, and I'll see you next time.